Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. Market impacts of the upcoming presidential visit to China. This video presents a direct informational narration of the source document. All right, let's dive right in. We've got 6 key areas from the source document to cover today. We'll start with macro and geopolitical updates, then look at the China visit catalyst itself. After that, we're breaking down the technicals for Boeing and Tesla, checking out NVIDIA and overall market concentration, and finally, we'll wrap up with the healthcare sector and a specific look at ISRG. Okay, kicking things off with Section 1, macro and geopolitical updates, specifically focusing on oil market volatility. So looking at the broader macroeconomic picture, the 4 major indices are showing slight gains right now. But what's really actively shaping the energy markets is geopolitics. Brent crude has actually rebounded, bumping up 3.91% to $104. The primary catalyst here? The U.S. rejected Iran's latest war-ending proposal, calling it completely unacceptable. Because of that, the U.S. National Security Team is now discussing next steps, and that includes potentially putting military options back on the table, while Iran has warned they're prepared for all options. What this does is set up a really critical waiting period. The market is watching closely to see if oil prices are going to push and hold above that $110 level, or if they'll fall and stay below $90. Moving on to Section 2, let's look at the China visit catalyst and the potential market-moving events surrounding it. Grab your calendars because the crucial dates to watch are May 13th through the 15th for the presidential visit itself. The most critical piece of this is the bilateral meeting scheduled for May 14th. That's where we could potentially see commercial agreements take shape, and this isn't just politicians. The delegation includes heavyweight executives from Apple, Tesla, NVIDIA, and Boeing. You'll also notice a placeholder for Q3 2026. That represents a highly optimistic market target for a potential full self-driving rollout, and we'll break down exactly why that matters in just a minute. To really grasp the potential scale here, it helps to look back at the historical precedent from the 2017 visit. During that trip, a delegation of 29 CEOs went along, and they announced over $250 billion in commercial agreements. Direct beneficiaries were massive. Boeing landed a $37 billion aircraft order, and Qualcomm secured a $12 billion chip order. Now, even though trade frictions later prevented some of those agreements from fully materializing, they absolutely injected significant short-term momentum into those specific stocks. For this current visit, the potential focus on big-ticket purchases, things like airplanes, agriculture, natural gas, and chips, along with the possible creation of a new bilateral board of trade mechanism to review regulated products. Now, before we get into specific stock impacts, the source text stresses a really important risk and disclaimer. These anticipated agreements are reasonable market speculations. They are definitely not guarantees. In a success scenario, any secured agreements would basically act as icing on the cake, giving a nice boost to current stock prices. But in a failure scenario, that expectation gap could quickly pivot market sentiment, turning straight into immediate short-selling pressure. All right, Section 3, Boeing's technical analysis and how it's preparing for a potential breakout. Keeping those constraints in mind, let's talk Boeing. There's a lot of anticipation right now about massive new aircraft orders, especially after Airbus recently secured some major contracts. Because of this, the absolute crucial point for Boeing is to decisively stabilize above the $240 breakout level. It's been testing that $239 to $240 threshold, which makes it the definitive benchmark for a technical breakout. Diving into the analysis block, if Boeing can decisively clear that $240 mark, it's going to challenge the mid-level resistance zone sitting between $248 and $260. And if it clears that area, we could be looking at an $80 upward gap right toward the $300 mark. On the flip side, downside support is firmly planted between $198 and $220. Now, fundamentally, Boeing's valuation is running high. Thanks to delivery delays, the estimated EPS for 2026 is actually negative, only turning positive in 2027. Even if you apply a peak 27.8 times PE ratio, that yields a fundamental price of just $112. So, what's happening is the market is currently pricing in the expectation that this massive order backlog will eventually turn into actual realized revenue. That brings us to Section 4, Tesla's technicals, FSD hurdles, and its notorious volatility. So Elon Musk is heading to China with the explicit intent of advancing full self-driving, or FSD, regulations. But as the source outlines, there's a major fundamental hurdle standing in the way. In late April, China indefinitely suspended new Level 4 autonomous driving licenses. Why? Well, it was triggered by a massive malfunction from a competitor on March 31st in Wuhan. Nearly 100 Baidu Apollo Go robotaxis hit a minimum risk condition, stalled out simultaneously, and caused severe gridlock. Because of his sweeping suspension on new project expansions, immediate FSD approval is highly unlikely. That's why the most optimistic market expectation has now been pushed all the way out to the third quarter of 2026. Looking at the technicals, Tesla has aggressively pushed right into a heavy resistance zone. This is basically the short seller's defensive line, between $420 and $465. If it can pull off a decisive break above $465, it could clear a path toward historical highs above $500. But here's the catch. With a daily RSI hitting 90, which indicates severely overbought conditions, we're likely going to need to see significant high-level consolidation before any further push upward. The source makes a point to emphasize Tesla's extremely high volatility and heavy speculative trading, specifically noting its habit of trapping capital through massive two-year cyclical price swings. Moving into Section 5, NVIDIA and Market Concentration, examining this $5.33 trillion giant. For NVIDIA, the massive potential upside catalyst during this trip is securing Chinese regulatory approval for its H200 chip purchases. The U.S. has actually already cleared these sales, subject to a 25% tariff or cut. What's crucial to understand here is that current forward earnings estimates completely exclude any Chinese sales expectations. So if they get that approval, it acts as pure, unadulterated fundamental upside. Currently trading between 30 to 40 times its 2027 PE estimates, the stock isn't even considered overly expensive. The mean hesitation in the market really just comes from its unprecedented, massive total market capitalization. And speaking of massive market caps, this tech rally is causing some truly historic market concentration. The overall technology sector's market cap has blasted past $23 trillion and now commands an incredible 37% of the S&P 500's total weight. And honestly, if you adjust for tech-adjacent companies parked in different sectors, think Amazon or Alphabet, that effective weight gets closer to 50%. Meanwhile, the healthcare sector, represented by the XLV ETF, has actually shrunk down to a historically low 8% weighting. Which leads perfectly into Section 6, the healthcare sector and ISRG's strategic valuation. This stark concentration gap brings us to our final macro-to-micro view, and it highlights a potential opportunity for mean reversion. To really put this concentration into perspective, the source draws a mind-blowing contrast in scale. NVIDIA alone is currently valued at $5.33 trillion. That means this single tech company is now larger than the entire U.S. healthcare sector combined, all 59 major companies in the XLV ETF, which total around $5.2 trillion. Now, healthcare has definitely faced recent headwinds from Medicare policy adjustments and drug pricing pressures, but its low relative weighting and defensive characteristics suggest some prime potential for a future sector rotation. When we evaluate our specific healthcare target, Intuitive Surgical, or ISRG, we have to calculate the risk strictly. The source introduces a concept called the Davis double play. This is a perilous market scenario where a stock suffers a simultaneous downward adjustment in both its earnings performance and its price to earnings, or PE multiple. While ISRG's earnings growth is still holding steady, its historically high PE multiple, which made sense back when it was growing rapidly, is facing a potential downward adjustment now that its growth has moderated to the mid-single digits. Looking at ISRG's valuation support, the stock just recently broke below $430, penetrating a massive two-year distribution top. If we apply a strict 30% safety margin to its forward estimates, the 2026 estimate of $429 adjusts down to roughly $300, and the 2027 estimate of $485 adjusts down to $340. These safety margin calculations directly line up with some massive downside technical support levels situated right between $258 and $295. Because of that, the specific institutional trade plan detailed in the source aims to increase an existing 1% position by an additional 7%, bringing it up to an 8% total portfolio weight. The execution target zone is strategically locked in between $321 and $405. And the strict execution rule here: do not rush the trade. The strategy requires waiting for a prolonged downward consolidation, and capital will only be allocated when a strong structural stabilization signal appears within that lower target zone. So we leave you with this final provocative thought drawn directly from the source material. As tech concentration peaks at historic highs and major geopolitical and bilateral catalysts unfold, how are you preparing for the inevitable sector rotation? Thank you so much for joining this explainer, and we look forward to reading your insights below.